Hey folks, it's Dave Burrows at Barometer, here with a quick but important hit here in the middle of August. Thought it was important today to have a quick conversation on markets and positioning because some very important things are happening market-wise. As most of you know, we have made the case that like every time in the last 100 years you exceeded the high from the previous bull market, you were in a new long-term bull market for stocks. And we did that in 2013 and had two very good years. 2015 into the spring of 16, there was a small correction, and when you put it under a microscope, it was a little bit more substantial. But in February of this year, the percentage of stocks in the NYSE that were in long-term uptrends started to expand from lows not seen since the depths of the European debt crisis in 2011. So when the percentage of stocks performing well gets to below 30%, and it's happened 5 times in the last 20 years, each case gave a multi-year buying opportunity for stocks. In each case, it was situations where the news seemed dire and people had grave concerns about what was going on, and of course that's what gets you to that point. When you look at the last 15 months in the market, we had two what looks like good-sized corrections through last summer, August through September, and then through January and February. But when you put it together over that 15 months, what's really more significant is just simply frustrating. 15 months of the market making no progress. This doesn't happen very often, where the market makes no progress but trades in a fairly tight range. And to put that into context, if you went back to 1950, there have been 1, 2, 3, 4, 5, 6, 7 situations that where for 500 days the market stayed in a range of less than 20%. Now, I recognize how frustrating that is, but look at the outcomes of all of those occasions. In each case, when the market resolved, it resolved to the upside for substantial rallies. 2, 3, 4, 5, 6, and here we are on the 7th. So don't let a quiet market bore you or get you frustrated. Market is now resolving higher. Market made a new high in June and has held that high. So market consolidated and has now made its new high. And we believe that this market is about to move substantially higher. When we look at all of the various countries that we cover, those that are in green on this chart all have expanding breadth, which is the majority of world markets. Yet, on average, only 51% of stocks worldwide are participating in this rally so far. That should expand to a much higher percentage, which of course over time makes it easier to make money. We've made the case for a couple of years that we are in a cycle that began 2012-13 where developed markets outperform emerging markets. That continues. We've made the case that in a bull market, the price earnings multiple that people are prepared to pay for stocks expands. And of course, that has been happening since 2011-12. It continues through the course of this year. That is the revaluation of an asset class where people are willing to pay a higher multiple. It happened all the way through the 80s and 90s, and it happened all the way through the 50s and 60s. Bear market, 1966 to 82, bear market 2000 through 2013 are periods where multiples contract. So we are in a different world today than we have been over the last 15 years. Now why? Well, it's all about relative value. Where would you put your money to be treated well? It's interesting when we look at the S&P 500 dividend yield versus the dividend yield, the interest rate on a bond. As interest rates have fallen over the last really 30 years, we've gotten to a point where one of the rare occasions where stocks are yielding significantly more than government bonds. The difference, of course, is though that dividends rise over time, interest rates are fixed. So we're getting a substantially premium yield to bonds, but we're seeing dividend growth. And of course, in our portfolios last year, we had 13% dividend growth in the portfolio. Now, a lot of folks talk about summer as being a bad time to buy stocks, and I want to challenge that for a moment. As we sit today, we are up about 6% year-to-date in the S&P 500 with 100 days left in the calendar. If you go back to 1928 and take all of the occasions where the market was up 6% with 100 days left in the year, this is the outcome. The rest of the year, in every case but 4 cases, was broadly positive. And in fact, on average, the market rose an additional 5% to finish the year. Of the 4 years that were negative from this point forward, 2 of them were 1987 and 1929, 2 years that were substantially different than the year that we're in currently. And of all of those years, and there's about 50 of them, the average return for the year was 22%. So given that we are up 6% on the year to date with 100 days left, that would point to the likelihood of a very strong finish to the year. Now, other people have said, well, the market's hitting new highs. That is a concern to me. So when you get into a new bull market, the new highs come fast and furious. So in the bull market of the 50s and 60s, this chart represents the number of new closing highs per year through the course of time. So we know there was a bear market that went on from 1929 to 1951. Of course, the market made no new highs in that period. When the market finally broke out, you could see each year there were many, many new closing highs leading up to the mid-60s. Then 1966 to 81 was a bear market, very few new highs. 1983 through 2000, of course, they came fast and furious in bunches. And then we went through the desert from 2000 through 2013. Now, 2013, 14 were excellent years. We consolidated through 2015, and now 2016, we're making new highs. In fact, yesterday, for the first time since January 1999, the Dow, the S&P, and the NASDAQ all made all-time closing highs. Interesting. Last time that happened was the end of a bull market. We are now in the early stages of a bull market, and we would argue that things have really only just begun. I find all of this very interesting when you consider where people have been putting their money. We know that we're 30-year lows in interest rates, and of course bonds have been a good place to be over the last number of years. But money is pouring into bonds at the lowest yields in history. On the other side, money has steadily been coming out of stocks, I think largely driven by the frustration that's been created over the last 15 years. In the last 3 weeks, we've started to see substantial flows into equities, which means that may only be the beginning. So when revaluation of an asset class starts, it goes on for a long time. It will always be frustrating looking backwards. The job that we all have as investors is to look forwards. We think that history is on our side, that markets are set up extremely well from a calendar perspective and from a long-term perspective and from a value perspective. So year to date, all of the pools and funds are having a good start. They're broadly positive. I'll highlight global macro, the equity strategy while we're in an equity bull market. The 3-year numbers have been quite good with very little risk. I would argue that even though it feels like the dog days of summer, people aren't much thinking about markets, it's a great time to do so. So I want to thank you very much for your time. I just wanted to do a quick hit. I thought it was important on the day after new all-time highs in all 3 markets. We continue to be very bullish and look forward to the rest of the year. Thanks very much and have a great weekend.